NC Personal Lines Exam. Welcome to the quiz. What is the primary purpose of no-fault or personal injury protection (PP) auto insurance? Is it A, to pay for property damage without determining fault? Or B, to allow drivers to sue each other freely after an accident? C, to pay for the insured's own medical expenses and lost wages, regardless of who caused the accident? Or D, to eliminate the need for liability insurance? The answer is C. No-fault or personal injury protection (PP) coverage pays the insured's and passengers' medical expenses, lost wages, and sometimes other costs resulting from an auto accident regardless of who was at fault. It is intended to provide quick benefits without determining liability. Property damage is handled separately. In no-fault states, lawsuits are restricted for minor injuries. Liability insurance is still required. Because PAP covers the insured's own injuries and losses without regard to fault, this is its primary purpose. Next question. Regarding a homeowner's policy, what does fungi coverage typically refer to? Is it A, coverage for edible mushrooms grown at home? Or B, coverage for mold, wet rot, or dry rot resulting from a covered water loss? C, a standard inclusion with no limitations? Or D, coverage for damage caused by any dampness or humidity? The answer is B. Fungi, mold, wet rot, or dry rot coverage in homeowners' policies typically pays for removal, remediation, or repair of mold resulting from a covered water loss like burst pipes, but is often limited in amount and excludes mold from ongoing leaks or neglect. Edible mushrooms are unrelated. No limitations is incorrect as caps apply. General dampness is excluded. Because it covers mold from covered water events, this is what it refers to. Next question. An insurer uses an applicant's credit information to help determine premium. This practice is regulated by which law? Is it A, the Affordable Care Act? Or B, the Fair Credit Reporting Act, FCRA? C, the Securities and Exchange Act? Or D, the Gramm-Leach-Bliley Act? The answer is B. The Fair Credit Reporting Act, FCRA, regulates how consumer credit information can be obtained, used, and shared, including by insurers for credit-based insurance scoring, and requires notice if adverse action like higher premiums is taken based on credit. Affordable Care Act is health-related. Securities Act is investments. Gramm-Leach-Bliley governs financial privacy, but FCRA specifically covers credit reports. Because FCRA protects consumers in credit use for insurance, this regulates the practice. Next question. What is the primary risk covered by the ensuing loss provision found in many policies? Is it A, the initial excluded peril itself, e.g. earthquake? Or B, a subsequent, covered loss that results from an excluded peril, e.g., a fire caused by an earthquake? C, losses that occur after the policy expires? Or D, consequential losses such as loss of income? The answer is B. An ensuing loss provision covers a subsequent covered loss that results from or follows an excluded peril, such as a fire that starts after an earthquake. Even though earthquake is excluded, the fire is covered if not otherwise excluded. It does not cover the excluded peril itself. Post-expiration losses are not covered. Consequential, like income loss, may be separate. Because ensuing loss covers the resulting covered damage from an excluded event, this is the primary risk. Next question. A single interest policy provides protection for whom? Is it A, both the property owner and the lien holder? Or B, only the property owner? C, only the lien holder, e.g. a bank? Or D, joint owners of the property? The answer is C. A single interest policy, also called lender-placed or force-placed insurance, protects only the lien holder's financial interests, like a bank or finance company, in the property. If the owner fails to maintain coverage, it does not protect the owner. Dual interest would cover both. Owner policies cover the owner. Joint owners share ownership. Because single interest safeguards only the lender, this is who it protects. Next question. In insurance, what is a rider or endorsement? Is it A, a document that amends or changes the original policy? Or B, a person who is an additional insured on the policy? C, a form used to report a claim? Or D, a receipt for a premium payment? The answer is A rider or endorsement is a written document attached to the insurance policy that modifies, adds, deletes, or changes the terms, coverages, limits, or conditions of the original contract. It becomes part of the policy. An additional insured is a person or entity added for coverage. A claim form is used to report losses. A premium receipt proves payment. Because endorsements alter the policy itself, this is their function. That's it for today. Don't forget to like and subscribe. Tell us how many you scored out of 6 in the comments, and let me know what topic I should post next. Bye.